Hello, and welcome to part four in our Intro to Investing series. The first three parts are all available in our YouTube channel. Today, we're going to talk a little bit about risk and return, how to get started, and just some other general kind of investing concepts. So, I wanted to talk a little bit about risk and return and, just how those two things relate to each other. So, the first thing to keep in mind is that investing is inherently risky. So, anytime you invest in anything, it doesn't matter if it's an individual stock or a mutual fund or a bond fund, there's always some element of risk. So, there's no guarantees. What is guaranteed is, if you have money at a bank that's insured by the FDIC, that is 100% guaranteed. So that's, sort of the difference between having your money sitting in cash versus investing it in really anything else. You're giving yourself some element of risk. And generally speaking, the more risk you're willing to take, the higher the potential returns, right? So you're rewarded for taking additional risk by seeing potentially better returns. So if you have a very aggressive portfolio, you're probably going to see better returns over the long run versus, if you have a portfolio that's entirely composed of bonds and bond funds and things like that, or other fixed income um, investments, then you're probably going to see very low returns because you're not taking a lot of risk. So the more risk you take and the more volatility you're likely to see, then that usually translates to higher returns. I also wanted to talk about just kind of zooming out in general. So when you look at investment performance, whether it's you're looking at your 401k balance or maybe you're looking at the S&P 500, anything like that, you're going to see a lot of ups and downs, and that's very normal. It's very healthy. But if you look at it too closely and if you look really regularly, you're likely to just create more anxiety for yourself. So it's really helpful to kind of zoom out. Don't check your 401k balance every day. Don't check it once a week. Really probably once a quarter is plenty. The more closely you look, the more you're going to just be tuning into those very natural kind of fluctuations, but it's just generally not helpful to look that closely. Um, so I wanted to just, go through a few things that I think are helpful in terms of, how to get started. So a lot of people, going through this series, hopefully you're a little bit more excited or feel a little more confident about, taking some initial steps to get invested. But where do you start? Just because you know what a stock and a bond is or a mutual fund doesn't mean you know which ones to pick, right? So I'd say the absolute easiest thing to do is take advantage of your company's 401k match, or you might have a 403b or some other type of retirement account. But hopefully your company has something set up and you're able to put money in and they will match it. So that's a really easy way to get started. It's also free money. So, you should ideally be contributing at least as much as the company is willing to match. And then, you might contribute additionally above that amount. Anything you can do to automate your savings and your investing is a huge benefit in the long run. So we all might like to think that we're going to do something on a regular basis. And, the reality is it often gets put on the back burner. But if it is happening automatically, that is just, a very easy way to get started. So your 401k, that is a perfect example. It comes out of your paycheck. You never see it. Once it goes into the account, it automatically gets invested, however you designated. And typically what we see a lot in those types of accounts is a target date retirement fund. So a target date retirement fund is just it's kind of like the easiest way to get invested in general is to pick a date. So, I might be retiring in 20 years. So I would pick a target retirement fund that's 2045, roughly. And then once you put the money in there, it's going to pick a broad range of stocks and bonds. And it's going to automatically get more conservative the closer you get to retirement. So those target date retirement funds are really great because it's a really easy way for you to get a very diversified portfolio, generally low cost, and you don't really ever have to think about it again. Um, as much as possible, I highly recommend taking advantage of any kind of retirement or other account that has some kind of tax advantage built into it. So that includes your 401k, or it could be a 403b, any kind of IRA. If you make, if your income is below the limits where you're able to contribute to an IRA or a Roth IRA, you can use those. An HSA, a health savings account, is another great tax advantaged savings account. So if you have access to an HSA, those are also fantastic. So anytime you can get money into an account that is growing in some kind of tax deferred way. So there's different tax rules with all these different accounts that I mentioned, and I'm not going to go into the details on this call, but anytime your money can be growing without having to pay taxes is a really nice thing. Using low-cost index funds and ETFs. So the episode 2 of this series was all about what the different index, mutual fund, ETFs, what do all those things mean? Generally speaking, we are big fans of index funds and ETFs. So keeping your costs as low as possible, not trying to outperform the market, but just investing in very simple, S&P 500 index funds, those sorts of things are a really easy way to get into the market. You want to save, if you can, at least 15% of your gross income. So gross means before any taxes or anything else is taken out. So if you make $100,000 a year, salary, you should probably be saving 15,000-ish a year, potentially more if that's possible. But that's just a very, it's a rule of thumb. So it's not precisely the right amount for every single person, but it's a good starting place. So if you're able to save at least 15%, and ideally in those tax advantage types of savings. And then the last thing on here is about, really about timing. And that's a huge aspect of investing is, when are you going to need the money? So anything that you're going to need in less than 3 years should be kept in cash. So if it's your emergency reserve, or if it's money you're saving up for a down payment that you want to buy, you're planning to buy a house in a year or two, I do not recommend investing money that you're going to need in the short term, because it's risky. And so when it's time to go buy the house, if your down payment fund is down 20% and you can't buy the house, then that's obviously kind of a worst case scenario. So anything that you need short term should be kept absolutely in cash, ideally FDIC insured, maybe even earning some interest. If it's longer than 3 years, it kind of depends on what your time frame is and your risk tolerance and all those things. But you can afford to be a little bit more aggressive for anything that you need that's further out than 3 years. And if it's 30 or 40 years, long-term, very long-term retirement funds can be invested more aggressively because you don't need them anytime soon. Okay, and a few more just kind of concepts and things to touch on in case we haven't covered any of these things. So I wanted to talk about what an asset allocation is. So an asset allocation is really, most portfolios will have like a mix of stocks and bonds, right? So you might hear something like an 80-20 portfolio or a 70-30 portfolio. And really what that refers to is just how much of the portfolio is in stocks and how much is in bonds. So in that case, we're probably talking about 80% stock, 20% bonds. And what's right for you very much depends on, your age and when you're going to need the money and what level of risk you're comfortable with and all those things. So there's no kind of one size fits all for that. But the nice thing about something like a target date retirement fund is that it takes a lot of the guesswork out of something like that. So if that's where you're getting started, is in a target date fund, that's a really easy way to just kind of back into age and when you're going to need the money and all that sort of thing. How you determine what's right for you, I mean, that's, again, very subjective and probably best done with, a financial professional. But many people have a sense of, how comfortable they are taking risk and those sorts of things. So you probably have some idea of, just how comfortable you are with, an aggressive portfolio versus a more conservative portfolio. I talked about the time horizon piece of it already, and that's just sort of, when is the money going to actually be needed? I touched on automating as well. So anytime you can automate, that just makes everything so much easier. The last thing on this list is robo-advisors. So robo-advisors are, places like Betterment, Wealthfront, some of the big custodians like Schwab have a robo-advisor option. And, you're paying for that. So it's not free, but it's a relatively low cost service. And, it's a robo, it's not a person that sort of makes these decisions about rebalancing your portfolio based on, whatever their tolerance is for how close to a target you are. But basically, I'm not going to go super far into the weeds on what a robo advisor is, but it's another really easy way to start to get invested without you having to go out and pick the funds. You're letting Betterment or Wealthfront make those choices for you and then reallocate the portfolio as needed. And so I'm a big fan of robo advisors. I think there's a lot to be said for working with a service like that. So, if you have access to an account like that, and again, you're not really sure how to pick funds yourself, there's absolutely nothing wrong with going with a robo advisor. The last thing I kind of skipped over it, but up above was about diversification. And I think we talked about that a little bit in a couple of sessions ago about just sort of the risk of having a lot of your portfolio in one thing. But just it's worth reiterating because I see it often that people, especially people that work in the tech world, often have a lot of their portfolio, a lot of their net worth tied up in their company stock. And the more that you have of that, again, just it's a little bit riskier. So if you have your money invested in lots of different companies and lots of different types of companies, so say US companies and international companies and emerging markets, all those things, that just provides you with it's a more stable portfolio and you're going to get access to the benefit of all of those different markets. So when one thing is up, you're benefiting from it. And when another thing is down, it's not quite as painful because you have your assets sort of spread out into different categories. So diversification is a really important component of having an investment portfolio that's going to be hopefully successful long term. And again, using something like a robo advisor or a target date fund will automatically get you a diversified portfolio. So I think that's all that I have to say. So if you have watched this whole series, would love to hear any comments or additional questions that you have. So questions can be sent to hello@zenafp.com. And if you don't have questions, that's also fine. Feel free to share this with anybody that you think might benefit. And then just want to throw in our disclaimer, which is that nothing that we have shared in this series is specific investment advice. These are all just for educational purposes only, and you should consult your own financial professional, advisor or tax advisor to get advice that is unique to your situation. So thanks for joining me and have a great day.